I'm just going to introduce our two speakers now before we get into our conversation. So first of all, we have DRI Dio, who is a senior banker for Africa on Barclays Private Bank in London. With 19 years experience in investment banking and wealth management, DRI is the lead private banker for East Africa based in London. After a career in New York providing capital market solutions to US municipalities and states, DRI joined Barclays in 2010. She initially worked in conjunction with Barclays Africa in delivering investment banking, corporate banking solutions to private clients and their businesses across Africa. In recent years, she's been working with private clients across Africa to help them invest and manage their wealth. We also have Urvi Shah, who is an investment advisor director at Barclays Private Bank, also in London. Urvi is a senior investment advisor and works with private clients and family offices based in Africa, the Middle East and South Asia. She has over a decade of experience advising prominent international clients on their investments and held similar positions at UBS in London, Standard Chartered Bank, prior to joining Barclays Private Bank. Urvi was born in Kenya and spent most of her early life in Nairobi before moving to London in 2005 to pursue an undergraduate degree at the LSE. So welcome both DRI and Urvi. Terrific to be talking to you today.
Thank you very much, David. Great to be here. Can you hear me well?
Can hear you crystal clear. So great to be talking. So yeah, DRI, just coming to you first. You know, you're the lead banker on East Africa for Barclays in London. What kind of perspectives can you share on clients from Africa with their wealth management journey?
Absolutely. It was actually great to be able to listen to the previous session, actually, because a lot of the points were touched. But now let's look at it from a lens of investments in global markets. So when we think about the African clients, right, I think we all have our views as to what it could be. But the simple reality is that an African client is actually a global citizen. You know, a lot of the clients that actually come to us are going to be individuals who have touch points globally, right? So they're entrepreneurs in a local market. They have a family business that they might have created now, or actually is part of 3 generations or more. But ultimately, what we do find is that they might have studied internationally. They might own properties internationally. They have children, as was mentioned in the previous discussion, that actually might have international touch points. And most importantly, their businesses most likely have international components to them, which Bimpe also was alluding to when she was talking about, you know, the oil and gas sector, the agribusiness, I mean, manufacturing. We can't think of any country that really just operates in isolation. So a lot of times we speak about the African clients, but you know, from our perspective, the global clients and are entitled to have the same services that global entrepreneurs around the world have access to. So that's one of the approach that we take when we engage with our clients. It's really a matter of understanding where are they in their journey. The keywords that our colleagues mentioned earlier that I thought were fantastic. Some about, you know, preservation of wealth is like, you know, avoiding erosion of the family wealth that was taking so long. We all know the challenges that could exist locally to be able to create that wealth. So the preservation aspect of it, it's so key for us. So what we start with is understanding our clients. That's the fundamental of everything that we do in our investment philosophy. When we start with that understanding the clients, is that you'll find that for African clients, there's a very strong concentration of risk. So it could be either with their businesses locally, it could be with real estate. I forget which one of our colleagues mentioned this, but we do realize that it's like there's such an affinity for real estate in the continent. It's a go-to when it comes to investment. But when you start with that as a mindset, you find yourself having your business being in your local market, your real estate being in your local market, and your excess cash being in your local market. For any discussion about preservation, one would expect diversification to be one key component of it. And what we do see as one of the main drivers of the African clients, you know, book is really going to be looking at geographic diversification as part of that strategic planning that the colleagues were mentioning before. And so as a private bank that's based internationally, we find ourselves to be a complement to their local strategy. It is not instead of their local strategy. So when we think about that African client, it's really thinking, how do we utilize what global markets have to offer to help them meet their ambitions for the long term? How do we think about their very specific needs and tailor the various investment solutions that are out there to meet their needs? And I think that's also one last point I'll mention in our initial introduction, is that when we think about investments, we all come with our views. Everybody has in their mind, it might be stocks, it might be this, it might be that. But when we're a large investment house, as we are, there's just such a large suite of solutions that exist. So we don't start with the solution. That's always the finishing point. So for us, planning and starting with the clients, understanding what their needs are, understanding what their family structure looks like, we assume that there's a next generation of clients who don't have children, and their needs could be different. We can assume that it's a father and mother, or it's patriarch. It could be a matriarch with a different view. So it's all about saying, it's like, where are you in your journey? You could be a financial tech individual as well, right? So that's actually new changes for all of us, having to speak to 30-year-olds and thinking about how do you plan for your investments. So starting with understanding the client, where they are in their journey, and working with them to essentially help mitigate a lot of the risks that exist today and could exist in the future, but future-proofing essentially their wealth. So that would be essentially our broad introduction on the African clients, which is as complex as any other client.
Okay, thank you. And Hervé, just to bring you in, why would you say it's important to consider investing in markets? I mean, we heard from DRI there about having, avoiding erosion of wealth. We heard from in the last panel about difficulties with currency eroding wealth, things like that. What's your view on that?
Great, David. Thanks for the question, and it's a real pleasure to be here this morning. So, as has been mentioned a few times now on this panel, the geographical diversification and the currency diversification are two key reasons that clients could consider an offshore bank account, right? And in the prominent global markets, so in the US markets, in the UK markets, in the developed markets, which is generally where we turn to in these kind of geographical diversification perspective, we've been faced with more than a decade of very low interest rates. And so essentially what that means is that if any cash deposits are parked in an offshore bank account, they're probably earning an interest rate that's very near zero. And if we then think about that in the context of inflation, so long-term inflation in these regions is likely to trend between 2 to 3% per annum. And what this effectively means is that any cash that's held offshore, which isn't being worked harder than that, is effectively losing 2 to 3% of its purchasing power every year. And so that's why investing becomes really compelling, because what you'd look to do ideally is invest in assets with a higher return potential so that we can help reduce that inflation erosion and then actually grow the funds over time. And then further, maybe taking a continuous and long-term approach, so having the additional benefit of compounded returns, which is also a very powerful force. So if we think about this in numbers, just to make it really real for the audience, if we had a pool of $1 million, let's say, of cash available in an account today, if we invested that money in a portfolio that earned 4% above inflation, that portfolio would be worth about $1.48 million in 10 years' time. But by doing nothing and retaining the funds in cash, that same $1 million would only have a purchasing power of maybe $730,000 in 10 years' time. So I think that's the reason, quite simply, that inflation is a compelling argument. It really does make sense. But as has been alluded to previously, I think it's important to take a step back and really understand what we're looking to achieve, because investments are simply a vehicle to get there. It's all about the client's goals ultimately. So I'll start with that, and then maybe delve in deeper as you progress.
Sure. And I mean, in terms of the risk and return conversation, if you're putting a new proposal in front of a client who's considering investing, and there's returns of a conservative portfolio, 3-5% return, it might not really excite them, because in emerging markets, there's higher rates of return available on a different risk profile. So how do you approach that conversation on risk and return? What's available in markets today? As you said, interest rates are on the floor. Low risk returns are very hard to achieve. How do you have that conversation with clients?
Yes, absolutely. It's a fantastic question, and naturally a conversation that we're involved in very regularly, as you can imagine. So I think, ultimately it comes down to what the purpose is of having this offshore pool of money, right? Clients often come to us with specific ideas for that pool of funds. So let's say it's to, create a store of value that they can use through retirement, or, creating a store of value that they can leave to the next generation. And so ultimately what drives the risk and return conversation is essentially what the pool of capital is available today, what that future goal is and how much funding is required for it and what sort of time horizon we're looking at. And then we can determine, what's a reasonable, rate of return that would achieve that goal. But also then look at the other side, which is the risk, as you mentioned. So now risk or volatility, as we call it in the investment world, is uncomfortable. But I think, in having this goals-based investing approach, we become more and more attuned, and clients become more and more attuned to realizing that the greater and more uncomfortable risk is not reaching the goals they've identified for themselves and simply holding balances of cash that eventually have very little purchasing power. And so that's one aspect of the conversation. I think the other side of things is that this isn't a kind of a one point in time exercise. It's a dynamic process because life is dynamic. We've spoken so much about changing circumstances, and markets are dynamic too. And I think in navigating that uncertainty around markets, that can be difficult. It can be uncomfortable. And so we work with clients a lot in kind of, understanding their emotional biases, their attitudes towards risk, their previous experience with markets and investments to really shape a very bespoke plan for what could be relevant, but also comfortable, in addition to helping them meet their long-term goals as well.
Okay, thanks. And once you've assessed that, then you're going to construct a portfolio with them. What are some of the factors there you would bring to bear to look at how they construct that portfolio?
Yes, absolutely. So, the first point, the goals are always, the starting point in the conversation. Very much in looking after kind of the client's nest egg, or this pension fund pool of capital, which is often what the purpose of the pools of capital are with us. That target rate of return will then determine, the levels of risk that we'd be taking. But in addition to that, so once we have that understanding of, the level of return, maybe the time horizon we're looking at, and also the client's comfort with, various aspects of the investment journey, I think it's then really important to go into kind of the nitty gritty or the finer detail of the portfolio. And essentially what we do here is really do quite a high level of due diligence and really, really understand that what we're picking is essentially high quality assets for the individual investment components. But another key part of that journey is also diversification, because whilst we can do a lot of due diligence and be very, very confident in the choices we make, markets do evolve, situations do change, and also unexpected things happen. And therefore, it's important to ensure that, all of your eggs are not in one basket, but spread across some very sensible bets. And again, the balance of that will very much depend on that target rate of return, the tolerance to risk, the tolerance to volatility, and that comfortable journey that we're looking to build for clients. The other aspect that comes into it when we're thinking about an investment portfolio is, the extent of control that a client may want in the individual investment decisions. Now, the vast majority of the clients that we work with are very busy and engaged with their day-to-day life, and also, generating the real wealth that they're eventually then putting offshore with us for a safe haven aspect. So we do have a lot of clients who prefer that very delegated approach, where they provide broad parameters, but then allow an investment manager who is specialized and focused on this to really drive the day-to-day investment decisions. But then again, there are some clients who'd like to look at every individual opportunity and evaluate it for its own merits. So then we can provide advice on a case-by-case basis as well. So it's all of these things that really come into shaping a portfolio.
So for a discretionary mandate there, you have to really build that trust, don't you? And I suppose you might do that by drip feeding money into the market. If someone's sat in cash, you're not investing that all, constructing a portfolio the full next day, and you're showing, I suppose, your approach and communication with the client, particularly if they're based in Nairobi and the manager's based in London. Having access to the team and building trust must be critical to getting that relationship functioning.
Yes, absolutely. But, in addition to that, David, I think it's also about, considering, I spoke briefly maybe about the emotional biases that we face when we come across, certain individual client situations. So, for example, building that trust is important, but it's also really important to maybe, separate the stress that one might feel in markets moving up and down from perhaps the control of the individual investment decision processes. And actually that works very well in terms of what you just said about, starting somewhere and then building that relationship over time, because creating this long-term and kind of systematic or rules-based program to continually add savings to this pool of money that's being built also creates that discipline to then not, panic in times of market stress or make knee-jerk decisions based on the minute-by-minute news we're looking at versus this long-term journey that we're ultimately looking to build for our clients in terms of that pool of wealth.
Okay, thanks. And DRI, just to bring you back in, I mean, an investment theme or trend that's talked about a lot in the UK is ESG and sustainable investing. We did a session recently with Barclays Bank on that point. I'm just wondering how you're seeing tastes for ESG and sustainable investing developing in the African context. Is that something you're seeing as a bigger part of portfolios? What's your view?
Yes, very much so. I would say there are two things. So when it comes to ESG, the African market was already involved in it with regards to business activities that our clients were undertaking. And it might have started mainly out of necessity. So what you'll find is that a lot of the many ESG solutions are actually great at bypassing, some infrastructure challenges that the continent has. So we already had a lot of clients that were already on the path of being in the solar business or other solutions that actually fit under the ESG umbrella nowadays, more globally. So for many of them, the education level was already there out of necessity, I would say, because of local challenges. But again, more broadly, I'd say the trend that we're seeing, globally is also clearly impacting the wishes of our clients. What I'll say additionally, I'll add that ESG is not being embedded pretty much in most traditional investment solutions. So when Hervé is speaking of discretionary portfolios as a way for clients to access markets, for a lot of our clients, this is not, there's an opportunity for them to still have access to markets, not lose returns, and still be able to have portfolios that they find tie very comfortably with their own aspirations. And also mainly the aspirations of the next generation, because I think globally speaking, the next generation is much more focused on those challenges. So without a doubt, ESG is becoming it's become the de facto standard in many of the solutions. So I'd expect in the next few years, many of the portfolios to have actually embedded them naturally.
Thank you. And are you seeing similar? I mean, the conversation's moving on now where sustainable investing is just part of good investing. It's about protecting and preserving capital. I mean, how do you see it for clients you deal with across the continent?
So, very much echoing what DRI said there. I think, ESG, so the factors around ESG are becoming very much embedded into all the offshore investment solutions available to clients. So that's almost the natural starting point. I think to DRI's point, I think clients were very accustomed to having this mindset maybe locally where they operated, but didn't really feel that there was much available in the offshore set before to really continue that mindset forward. And I think now what we're having with financial innovation, awareness, and just much more choice available, we are really able to kind of take that trend through to portfolios. And not only are we talking about ESG, which is kind of now our basic, very, very natural way that we look at all investments, but we're taking that one step further, embedding impact and talking really about sustainability and driving change rather than just having a portfolio that's good. We're actually looking for impact producing portfolios as well, and investment ideas within that range too. To reference a conversation that I think the last session touched on briefly as well. We're seeing a lot of interest in that space, in particularly the more illiquid or the private equity side of things as well. And again, with more interconnectedness of global markets, more opportunities available, it's a really great diversification play for clients based in the African continent to be able to access that mindset of opportunity that they're already operating with locally, but in another location. So taking the specialism they have and putting it into something different and diversifying that way too. So it is very much a big part of what we're doing today, yes.
Okay, thanks. And in the last session, we were talking about global families, children coming to the UK to study or buying property. I mean, you're based in London. How do you work with clients, particularly with on things like acquisition, credit for property or things like that? What's the services you're typically providing?
No, absolutely. So being able to be based in the UK, where it's actually there's a strong nexus with at least English-speaking, African countries. A lot of our clients have a foot in both, in both countries or both continents. So with regards to our services, we differentiate ourselves with the ability of offering a full suite of services that go from banking, credit services, both with regards to property acquisition, but also for release of equity out of portfolio, and that was actually very important in terms of COVID. I hear a lot this conversation of global versus local, and I'm like, no, it's complementary. So this year, for example, when a lot of the clients were having challenges locally, they're able to take liquidity out of their portfolios they had with us internationally to be able to support their businesses and their economies locally. I mean, I appreciated Madabush's comments about saying how important it is to actually support communities. And I have to say how impressed and just proud I was to see how much our clients were willing to support their employees and also the wider community around them. So that's one of the ways we're having a global asset that's working for your local needs is quite powerful. As you mentioned, when it comes to properties, when it's for family reasons, with children moving around or just retirement needs. So that's obviously something that we're also very pleased to be able to assist our clients with, or just even also sometimes for corporate properties as well, commercial properties. Diversification all across the board is necessary. I mean, so even if real estate is something that they look at as an investment strategy, being able to be across a jurisdiction also helps them with that journey. And then obviously investment, which is clearly one of the areas where we differentiate ourselves. On the point of investment, you mentioned something about risk and return, and when clients look at some of the lower returns locally versus the potential returns, how do you call it, in their countries. And I think to Bimpe's point, I think it's not one or the other. Once again, is because when you look at the risk, the portfolio it has to be, and I think we need to get to the habit of looking at your overall assets. That's the portfolio. It's not your Kenyan asset or your Nigerian asset plus your UK asset. Is when you take a look and you look at that really complementary portfolio, it is okay for some assets to return a little bit less if they're actually providing you a certain protection, or they're actually providing some type of benefit that might not be quantifiable in that way for the short run. So yeah, again, back to that blending of your needs across jurisdiction. So that was just one additional point to add there.
Thank you. And I mean, do you still see strong demand for the UK from clients in Kenya, or where you deal with clients commonly and frequently? Is education, business opportunities? What are the things that drives them to be interested in coming here?
Well, I think there's just a very natural link with the UK, isn't there? For Kenya specifically, but I think for countries across Africa. I mean, my history, my story is probably the best demonstration of that, having grown up in Nairobi and then moving to London and eventually settling down here with a lot of family in Kenya. So I think there is a very natural link, but it's also this, the real estate aspect. There's a very natural, it's looked at as the kind of one of the key jurisdictions from a diversification point of view. And, to draw back on a point I made earlier, whilst your advisors may be in, the UK, they may be in Switzerland, wherever they may be, we're talking much more globally these days, and investments are not, they're not subject to the location you're based in necessarily. So while, UK real estate might be one compelling asset class within an overall portfolio, we're still discussing a very global aspect. I think particularly at this point in time, given technology is such a big focus and it has been such a big winner for portfolios, we're looking a lot at the US markets for technology opportunities specifically. That's been quite a key driver of growth. And also, a macroeconomic trend that we can't argue with. Digitization is real and it's happening, and COVID has probably brought that forward a few years, in terms of how quick that trajectory has been. And I think that's the key theme that we're seeing, incorporating into a lot of portfolios in the US, but also within, Asia as well.
Okay, thank you. And Dira, I mean, I mentioned to Bimpe about how servicing clients from London has changed through COVID. We've all adopted these technology habits. How have you find working supporting with clients and dealing with other professionals through this time?
Absolutely. Again, really impressed with how we coped last year as soon as the crisis came, the ability to just, carry on. And it was a very volatile market at the time. So being able to speak with clients on a regular basis was just absolutely crucial, and I think a big differentiator for all of us. I fully agree with what she mentioned in regards to for existing clients, because our business is one, again, when I started our conversation, was one of knowing your clients. So we spend a lot of time with our clients, and they know us well, we know them well. So it's been fantastic to just be able to continue the conversation with them. A lot of my calls were just care calls, let's be very honest. I just really wanted to make sure they were okay, that their families were okay. So for that, sorry. So I think that was also,
sorry. Go ahead, Dira.
So that was actually that was quite important at the beginning. So for existing clients, that was, I think, was quite important. For advisors and for other financial professionals, I think, again, fantastic to be able to just connect with so many jurisdictions and being able to just be able to move forward the discussions to how can we help clients. Where the challenge is regards to new clients, because so much of our work is, again, getting comfortable, knowing each other. We've been able to onboard new clients through this journey. In a way, actually got better because we got approvals to make some of the onboarding digitalized. So that was fantastic. But there's definitely challenges with new clients, but we're still willing to do it. For those clients that are comfortable with digital, we can just do it in this format. So it's been fantastic.
Perfect. Just as we draw this little segment to a close, Urvi, do you have any closing comments, thoughts people should be thinking about? What's the key kind of takeaway from this from the investment world?
So I think diversification and long-term compounding, those are two real powerful forces. Some call them wonders of the world, investment people only, of course, but those are the two key things I'd suggest, clients continue to think about in the context of this offshore investment world. And, within that, that currency erosion, the inflation erosion, doing nothing is an active choice, and that can really work against you. So I think that, doing something, putting money to work and using diversification and compounding, that would be my takeaway sentence.
Okay, thank you. And DRI, do you have a closing comment as we wrap up this little section?
No, I think Urvi did it well. Just stay close to your advisors, because just get as much information, regardless whether it's with lawyers, accountants, etc. Just knowledge is just very important in such a complex environment. So always happy to speak with individuals and take the time that is needed for them to feel comfortable with any solution that's presented to them.
Perfect. Well, look, thank you for talking to me today. Anne, I think I can hand back to you to take the session forward, but in the last 90 minutes, I think we've covered a huge amount of ground. Very interesting topics, great insight from a range of speakers. Hope you enjoyed the conversation so far, Anne.
Yes, I'm really enjoying the conversation. I believe a lot of us are doing the same thing. And I really want to thank the Barclays Private Bank team for sharing with us, like you mentioned, for some of us in Africa, especially in Kenya, we're really connected to the UK, and we're really talking about how do we support our Africans, the opportunities on the continent, but their opportunities globally. So thank you for sharing us, and at least ending with those two things that we talk about in the investment world, diversification and long-term compounding.